American investor Michael Burry, who shot to fame in the global financial crisis of 2008 and whose character was played by none other than Christian Bale in the movie The Big Short, has warned of the greatest speculative bubble in the history of stock markets. He owns a hedge fund and one of the most respected money managers on the Wall Street, so his words can be trusted upon. His recent comeback on the Twitter with the hashtag #PigsFlying360 has shaken the Wall Streets. But who is this guy and why the fuck the Wall Street is scared of his words? Michael Burry is an American investor most popular for his billion-dollar bet against the United States housing bubble back in mid-2000s, which eventually took the form of a book and a movie in which his character was played by actor Christian Bale. Burry is best known for being amongst the first investors to foresee and profit from the subprime mortgage crisis that occurred between 2007 and 2010 in the United States. When the billionaires lost their billions, Burry made a fortune. In the year 2005, Michael Burry began to suspect that the booming US housing market was virtually an asset bubble inflated by high-risk loans similar to what happened in Japan in 1989. Burry created a new sort of financial instrument called a credit default swap, which would allow him to short the housing market. It means that he adopted a selling position on the assumption that housing prices will drop. When banks and creditors argued that the housing market was stable and prices in fact kept on surging, his clients grew angry and fearful as Burry continued his short plays. When they demand their money back, he placed a moratorium on withdrawals from the fund, angering his clients even more. He recognized that poorly structured, high-risk packages of loan securities known as collateralized debt obligations, CDOs, had received AAA rating from credit rating agencies, implying a degree of safety they didn't deserve, and are furthermore being repackaged and resold in the highly questionable ways. Michael Burry concluded that the housing bubble would ultimately burst and may in fact lead to the collapse of the US economy. He began shorting the financial sector. Wait a minute. Confused about shorting? Well, let me explain. In a conventional way, which is called the long position, the investors profit if the value of asset rises. That's what happens to you, right? You invest in a stock, you wait for it to rise up, and then you make money, right? But in finance, there is another terminology. Being short in an asset means investing in such a way that investors will profit if the value of assets fall. Let me give you an example. Let's suppose that you are an investor and you had a dream last night and you saw Elon Musk arrested for an electric car scam or a sex scandal. Now you go to a person called Donald Trump, who has Tesla stocks valued around $100 per share and borrows 10 shares from him. And of course, needless to say that you would pay him interest on borrowing those stocks. That's quite obvious, right? Then you sell those Tesla stocks at $100 per share to Joe Biden. Now, you are speculating that Musk would be arrested, and when he would be arrested, Tesla shares would take a hit and would touch the ground. And your dream come true, and finally, Elon Musk is arrested and Tesla shares do hit the ground and goes as low as $50 per share. Then you go back to Joe Biden, buy back your shares from him at $50 per share. And then you return those stocks to Donald Trump, from whom you borrowed those stocks, with of course some interest. Now do the math. You borrowed 10 shares and sold them to Joe Biden for $100 per share and made $1,000. And now you bought back your stocks from him at $50 per share and gave $500 to Joe Biden. Now in this whole game, you made $500. This is shorting, my friend. Now this short can backfire quite hard, as it did with the GameStop stocks. Suppose Musk wasn't arrested. On contrary, he was awarded by the Chinese as the Green Man, and he and his stocks take up the sky and reaches $200 per share. Then you would have to buy back those shares from Joe Biden at $2,000. and would pay Joe Biden extra $1,000 from your own pocket, in addition to the interest to be paid to Donald Trump. This thing happened to GameStop. Big hedge funds on the Wall Street were shorting the GameStop shares with the hope of a big fall in the GameStop shares. But their speculation was fucked by some Redditors who raised the stock prices of GameStop to a massive height. And Wall Street hedge funds lost big buck of money at the Wall Street. Now let's get back to our protagonist, Michael Burry. While investing in the US housing market, he lost millions of dollars and many of his investors who didn't have trust on him. However, he emerged to make billions when the housing sector finally collapsed and triggered the global financial crisis in 2008. Michael Burry made money when people lost theirs. Burry has also often considered the so-called meme stocks, the term that has now emerged to describe the companies with share prices that have been caught up in social media fueled buying trends. The meme stocks are those company stocks that have less financial substance but whose share prices rise exponentially high due to an ongoing social media trend, like what we saw with the GameStop stocks. Previously, Burry has compared the social media hype around Bitcoin, electric vehicles, and other such stocks to the dot-com burst and the housing bubble. Now, Michael Burry is sounding another alarm to the hyper-heated Wall Street giants.